Welcome to PhillipCapital's Weekly Market Watch. We have seen the US dollar going on a downward trend, and conversely, equities and commodities have been rising steadily. We have Ms. Hilary Holt, investment analyst from Phillip Securities Research, to discuss if the current trend will continue. So Hilary, it is no secret that the US dollar is losing its mojo. What are the factors at work driving this ahead?
There are internal and external factors at work. Externally, we have China pushing to have its own currency to be included in the IMF's basket to fund payments for bilateral trades. And internally, we have the US government printing more money to fund the increase in spending. So such actions will only deface the value of the dollar further.
The falling dollar has pushed the price of the crude oil contract for July delivery to near $72, which is a new high for this year. Can crude continue its upward march, or will it rarely run out of gas?
Generally, summer is a seasonally strong period for oil, but there are other factors at work as well. Supply and demand is a constant issue for all commodities, including oil. The current perception is that oil demand will increase with stronger economic activities and that stability within the broader US economy might be on the horizon. The other half of the perception equation is that actual supply of crude seems to be falling. Data from the American Petroleum Institute last week showed US crude inventories dropped more than expected. So the stock level fell by 1.6% relative to a decline of 0.22% in the previous week. So with such conditions at play, I think it's likely that crude will move further in the near term.
The momentum in the equities rally seems to have simmered relative to previous months. What could have explained the lackluster performance?
Okay, the upbeat momentum seen in the equities has indeed simmered relative to the previous months. I think this is because as there are concerns with the sustainability of the strong advance since 9th of March, and also that the government's debt load is growing up so large that it will lead to higher inflation and soaring interest rates. So higher interest rate could hamper the economy's recovery by raising borrowing costs for consumers, and inflation could also discourage them from spending. So, despite this adverse news, right, I would think that the market has been rather resilient. This is so as we have seen days during the month whereby Dow could have slid as much as 123 points in the day, only to recover the end of the day flat.
Do you think equities will advance further in the near term?
I think in the near term, the return of risk appetite and also the fear of losing out on this rally might propel equity markets a little higher. However, it's important to bear in mind that the recent rally has been built on better than expected data. So while economic conditions have improved relative to half a year ago, it still remains very much below normal levels. So as such, I would think that disappointment with the strength of the economic expansion will take some heat off the latest rally, and any advance will be lackluster in performance compared to the previous months.
Thank you, Hilary. That's all we have for you today. Tune in next week for more market updates.